Well, we're definitely celebrating 5 years in existence, because we're still standing for one thing. But another thing is we've got performance that's worth celebrating. And I think, if you look at all the tips we've made, some 170 plus tips over those 5 years, we've got an average return of close to 30%. And I'm sure we've picked some winners and, we've picked some losers. But I think what we've seen is certainly there's been an increasing appetite for investors in the small cap arena because of lower interest rates, meaning that the cost of capital is low. So people are looking up the risk, are looking higher on the risk curve for the same sort of returns that they were expecting before. And in that environment, we've actually been telling people to take profits most recently, and I think that's a good strategy, because I think what we've seen this week is definitely some volatility, and that's going to continue as people come out of their northern hemisphere, exit their summer holidays and start getting back to business. So we're going to see more volatility, and in that environment, we believe that we'll see more opportunities for small caps. What we're looking for in the small cap is a growth stock that's priced in value prices, a growth stock that's priced as good value, and that's very hard to find. When we have found it, it's certainly a case of just jump on board and hold for your life and watch the momentum sort of take off. And we've seen that with Certex, we've seen that with Bellamy's, we've seen that with Impedimid. These stocks can grow no matter what the economic conditions, and they have a great business model, which means it doesn't cost much to achieve that growth. And shareholders have definitely sort of flocked for those stocks, but very quickly they become very expensive. And every now and then, their big companies fall on hard times, and lots of these companies have certainly, I guess, big revenue lines, so they're making literally billions of dollars, but their profit margins are quite small, and that means big leverage. So when they're not going well, their share prices go in the wrong direction, and eventually, kind of, these stocks can fall into our universe of sub 300 million market cap or thereabouts, of which is the vast majority of companies on the ASX. And when they do come into our universe, we look at them very closely, because you've seen that leverage on the downside, and we're looking for the same sort of leverage on the upside when conditions improve. And examples in the past have been UGL, APN. These are companies that to an extent have been reinventing themselves, but they've got a great asset base to start with. Some of these companies have really strong balance sheets and can actually perform well in times when people aren't opening up their wallets, so in times that are tough. And those sort of companies, I guess, have more resilient earnings than the market gives them credit for. Nick Scali is a classic example of that, and they have a great competitive edge, with a strong balance sheet and a strong product that's not easily replaceable or replicated. There are other companies that in the food sector that have ticked these sort of boxes, like Capilano Honey and Freedom Foods. These are companies that at one point were trading at much lower levels on kind of sensible multiples. But I guess as they've improved their earnings over time, they've been re-rated. And at certain points we've been taking profits in those sort of companies. One of the geniuses of Santa is literally to pluck something from nowhere. But these things don't come from nowhere. They come from businesses that are good business, but they're being mispriced because they've got a loss-making division. Or like in the case of APN, they were equity accounting a lot of assets, and then they basically bought some businesses, sold some businesses, and the market got a better understanding of what their cash flows were. So it's simply it's simply, I guess, taking advantage of a lack of insight that many have of certain businesses because they're overlooked and they just seem a bit too complicated. And that's what our team specialises in, is looking at the detail in the reports, seeing the accounting principles which underlie the profits, and looking to see if that might change. And that's why we're always looking for more gifts under the Christmas tree for our subscribers. It's pretty exciting because it's rare that you get Jeff Wilson and Carl Siegling in the one room, and I guess it's illuminating to find out what they've learned over the years about how to be a successful investor. And I guess once all the funds management business is taken out of the equation, that's what they've got in common with everyone that's trying to make money, is that they themselves are just simply looking to every day to be better investors. And a lot of it comes back to when they first started investing and the mistakes they made. So we look at the pitfalls, and we look at the difference between the number of wins and losses you make in your portfolio versus the dollar amount of the wins and losses. So like someone like Carl said, he's over 22 years, he's got a win-loss ratio of 56 to 44 in terms of numbers, but in terms of dollar amount, he's got a 2-to-1 win-loss ratio. In terms of he's made $2 for every dollar he's lost. Yeah, things like this really provide a good perspective, as well as their early stories of when they first went into a stockbroker.